After 43 days, the longest government shutdown in American history is finally over, but the political fallout is only just beginning. Joining me today in studio is Zoran Kresovic from Blueberry Markets. Good to see you, my friend. What ultimately pushed Congress to break the cycle?
Well, it was a number of things, actually. I mean, we've seen the whiteys actually come through. They're passing on the bill. I mean, it has been a long period of time in the making. In fact, actually, it's the longest government shutdown in history. And I think there's been around 20 or so since 1979. But the good thing is, it is ending tomorrow. Hopefully, it will have positive implications on the market. And hopefully, we'll get a sense of certainty as well in terms of the Fed interest rate decisions coming through over the next couple of weeks as well, or December interest rate cut, and also provide to us a little bit more clarity where we're heading to in 2026.
Which so many people are desperate to know. But how big a political gamble did moderate Democrats take by crossing the aisle, so to speak? Take us through a bit about some of the movement there.
Well, it certainly has, and you know, we've seen a lot of that coming through over the past couple of months. There's been a lot of going backwards and forwards. You know, from Trump, we are getting all this positive outlook on the economy, and the economy is doing exceptionally well, especially with tariffs. The data may suggest something slightly different. And especially if you're focusing on some of the key components of the economy, such as non-farm payroll, CPI data. But again, the biggest issue right now with the government shutdown is the fact that we actually missed a whole heap of data coming through over the last couple of months. And we actually don't know where we stand right now. And I think the positive thing with all this is that now we're going to start actually getting some of that information out, like, you know, I believe non-farm payroll data for the month of September is actually due to come out. So we are about to publish the numbers, and that's going to provide a lot more clarity to the market. And as you probably know, markets don't like uncertainty. They actually like a lot of clarity as well.
Yeah, absolutely. So by doing that, there's sort of delayed a little bit, put us behind. But with funding only lasting until January 30, I believe, how real is the risk of perhaps another shutdown? I know there's been whispers of this in the ether.
Yeah. There is a risk, and there is always a risk that, you know, something unexpected could happen. And we've actually seen that in particular with the mandate since, you know, US President Donald Trump has actually come into power. It's actually very common that there is all these unprecedented things that can actually happen and occur, you know, out of nowhere. Yeah. But at the same time, I still think that, you know, the core focus that we should be looking at is the key data and information that's coming through. And then how is it going to impact the global and US economy over the next 6 to 12 months? What we're actually seeing right now is that reinflation is coming back into the US market.
Right.
And on the back of that, we could be actually having some concerns heading into 2026.
Take us through some of those concerns that you might be having. Obviously, we don't have a crystal ball, but that uncertainty is sort of, you know, tainted the year ahead, if in some ways. Take us through a bit about
Well, just to put things into perspective, with the US government shutdown, right, that tends to impact approximately 0.1 to 0.2% of the GDP on weekly basis. You know, with regards to, let's say, for example, contract workers in the US, you know, the moment that these things have actually occurred and government shutdown came into effect, these people are actually out of job or not getting paid. The moment the government shutdown actually does stop and these people come actually into the employment side of things, you know, they're not reimbursed or repaid back for the period they haven't actually worked in the past. Yeah. That's just one element. Now, when you're actually adding that on the, you know, on the non-farm payroll data, when you're actually adding that into the, or baking it into the employment cycle of things, that can actually maneuver and you can manipulate the numbers heavily. On the back of that, I would actually expect that we will get probably a lot more volatility in the market. And seasonally, if we are going back throughout history, generally speaking, you know, global equities tend to perform quite well at the month of September, November and December, going into the seasonally adjusted period where there is what's called a Santa rally. Now, I'm not quite sure whether we will get that right now, and that's why I think we're actually seeing a lot of concentration and capital and flow going into what's called commodities,
Yes.
in particular gold and silver, because we're actually seeing a lot of hedging and basically protecting against any potential downside
Those
risk.
precious metals tend to come up from time to time. Do you want to run us through a little bit about what we're seeing when it comes to gold and silver just before we move on to Australia?
Sure. So in terms of gold and silver, what we're seeing is an exceptional inflow, not only of retail money coming through, but also central banks across the globe. So we've actually seen over the last 6 to 12 months, there's been a whole heap of challenges and issues globally. We're also seeing reinflation coming back fully into the market. Right. Good point right now is that a week ago, Fed or Jerome Powell was actually anticipating and providing more clarity on another interest rate cut in the month of December from the US, so 25 basis point cut. Now this morning we're actually seeing the markets completely reverse that. We're seeing the US dollar strength, and we're actually seeing gold and silver slightly come off over the last couple of days. What's that providing to us is uncertainty in the market. Volatility index is actually escalating or appreciating right now. And on the back of that, US dollar is gaining quite a bit of strength. So right now, as we stand, we only seek a chance of 45% that we will get the interest rate cut in the month of December from the US.
Interesting. All right, well, let's jump over to the ASX for the moment. And Wall Street may look calm on the surface, but tech swings, shifting rate expectations, and a surprise Buffett-backed surge in Alphabet are setting the tone for the ASX to open. So, Ron, what's driving the ASX lower despite Wall Street's relatively steady headline numbers? Take us through.
Sure. So overnight, US markets haven't actually performed the best. We've seen a bit of a pullback. We do have NVIDIA reporting on Thursday. I think all eyes on that, and we're taking a slightly cautious approach, or investors are taking a slightly cautious approach, with jumping into the equities market right now. On the local front, we are probably going to receive some of the negative flow from the US overnight, and we are likely to see probably a little bit more downside. I think the important aspect that we need to take into account here is that market was actually pricing in Australia, or the RBA was, that we will probably get another interest rate cut by year end, or at least in the month of February 2026. We've seen with unemployment data last week that unemployment data is lower than what market was anticipating. So unemployment data came at 4.3%. Consensus was at 4.4. For the month of September, it was actually at 4.5. So there is a strong engagement in the labor market and employment in Australia right now. On the back of that, RBA is likely to push back any further interest rate cuts, and that's obviously paving a way for interest rate sensitive or cyclical sectors on ASX. And we're actually seeing a bit of a rebalance, and we're seeing a bit of a sell-off coming on the ASX right now. Now, in saying that, today we do have RBA minutes, which probably not going to provide too much clarity because we've seen the figures come out last week. But still, it will be important to see whether RBA Governor Michelle Bullock provides any more clarity, and whether the tone of the commentary is slightly tilted towards hawkish or dovish. And I think markets or ASX should actually start to bake that in.
Yeah, 100%. Zoran, I want to thank you for joining us on the program. Anything to leave us with when it comes to the ASX?
Look, I'm still of the view that we might see a little bit more upside, despite the fact with unemployment data last week. I still feel that we are lagging, if looking at in the nominal terms and percentage terms, to where global equities are. I still feel there is actually a lot of good sectors that could outperform over the next 6 to 12 weeks. In particular, I'd be focusing on healthcare. There's some really good stocks there. I'd be also focusing on material sector. I know that's probably the best performing sector on ASX year to date. The bigger players, BHP, Rio, they're doing quite well. Iron ore prices are going up. Commodities in general are doing quite well at the moment, and I still feel there is actually a lot more upside, especially at the end of the bullish cycles. And when looking at the cycles in general, we tend to see the bullish cycles actually occur within equities anywhere from 12 to 18 months. We've already had a solid 12 months on ASX. I still feel there is probably another 6 months to go. And some of these material sectors and or stocks could actually outperform the market and provide a lot more upside.
Interesting. We'll have to keep an eye on it. But Zoran, thank you so much for joining me in the studio today.
Thank you for having me.